everyone. I'm ready for the webinar, and let's start. My name is Elizaveta Belugina, and I'm the head of analytical department at FBS. And today is our weekly webinar on the weekly Forex outlook. We'll discuss the prospects for the main currency pairs for this week, share trade ideas, and discuss both fundamental and technical factors. Let's start as usually with our presentation. And once again, the agenda for today is market positioning, economic calendar, technical analysis and tips, and then we summarize trade ideas and the market outlook for these currencies. To begin with the market's positioning, we study data provided by Commodity Futures Trading Commission, or CFTC. This data shows us how the large speculators act at the currency market. We can see that the aggregate US dollar long position is still rather solid, despite the fact that it has declined a bit from the previous highs. All in all, we are starting the data for the week which ended on Tuesday, November 15th. CFTC data come with a bit of a time lag, but still we can try to grab some important moves of the market of large players when we look at this data. We can see that traders covered short positions in the euro. Here we can see that the short positions is still sizable on the euro, but it has decreased. The weekly change was positive. It means that the number of net bearish positions on the euro has declined. Also, traders have decreased their bullish bets on the Japanese yen. Here we see a decline in the weekly change, and the net long Japanese yen position is no longer the largest long bullish position among the major currencies. We can see that now the long position in Australian dollar is the largest. It's more than $3 billion. As for other currencies, also we can see that negative bets on British pound were decreased by the market. And as for commodity currencies like Australian dollar and New Zealand dollar and Canadian dollar, the net bearish positions on Canadian dollar were trimmed a bit. It happened as oil prices recovered, and Canadian dollar is getting support from the oil prices. Also, we see that Australian dollar bullish position has been covered a bit, but it remains the largest long position. And as for the New Zealand dollar, we are in the neutral territory, and the very small bullish net position, but it's not very significant. These are the market trends. We have to study them and use this information for our trading. What can be our conclusions from this data? The conclusion is that after the US election, after Donald Trump was elected the US president, US dollar is still enjoying demand, and they see that the currency is enjoying demand of large speculators. Still, there was some correction in position of the market players. The market has become less negative on the euro and British pound, but as we will take into account the new data for the week which will take place since November 15th, we may show that we may see that the situation has changed and that more negative positions on the euro and British pound were built. If we look at the US dollar index chart, here is the daily chart of this instrument. We can see that there were a lot of days of gains of the US dollar after this candle with a very long shadow to the downside. This is the candle which was formed after the US election day. The greenback was rising straight higher and higher. There was even the opening gap at the beginning of last week. And now we are seeing a kind of correction on Monday. All in all, the possibility of the Federal Reserve's rate hike in December is now exceeding 95%. And the reason why the US dollar has made such a great rally to the upside is that traders were pricing in higher possibility of December rate hike by the Federal Reserve. They were pricing in this outcome, and now we see that December rate hike is almost fully priced in the current rate of the US currency. The conclusion from this is that probably during this week we won't see any big moves in the US dollar, as probably the incoming economic data, we won't have some big events in America which can change this situation. The reaction of the market should be rather moderate. The US dollar will probably lack the fuel for further rally. It won't be able to significantly renew these maximums, but some correction is quite possible, but we don't think that this correction will be deep. Support is located at 100.50 mark, ahead of 100 level. These are the next important support levels for the US dollar index, which tracks dynamics of the US currency versus the currencies of America's main trading partners. And I think these levels will limit the decline of the American currency. Last week, the Federal Reserve's chairwoman, Janet Yellen, has confirmed that the Federal Reserve is leaning towards a rate hike in December. All in all, data from America remain strong. We have rather strong employment market. Inflation figures for October were also good, surprisingly good in the US, and all in all, American data is fine. Well, it really is in line with this scenario that the Federal Reserve will have to raise rates in December. I think that the US currency has made already the biggest part of its rally, and that this week we will have a kind of pause in rally, but as we can see, the expectations of the Federal Reserve's rate hike is not the only reason which keeps American currency in demand. And the second reason is that traders think that Donald Trump will introduce massive fiscal stimulus in the United States, and this will increase inflation in America, driving treasury yields to the upside and consequently driving the greenback to the upside. These expectations of Trump's policy will remain, and these expectations strengthen monetary policy divergence between the United States and other developed nations. We can see that only the Federal Reserve is close to raising interest rates, and at this time the cycle of higher rates may be more intense. Traders can price in further rate hikes in 2017, and as a result, the US dollar may have potential for further gains after some correction to the downside. Also, if we are speaking about more near-term horizon, this week we will have Thanksgiving Day in the United States on Thursday, and this holiday also may help to limit the short-term gains of the American currency, as all those traders who have been buying the greenback after the US elections may take profit at the current levels, which around 101.50, and just relax for a while to have their long weekend and to stay out of the market. So liquidity will be lower and the US dollar may drift down to 100.50 and 100 support level. This is a psychologically important mark for the US dollar index. Also, let's have a look at the economic calendar, as we usually do. This week is not very eventful for other major currencies as well. Here I have listed out the most important events, and we can see that there are rather few of them. On Tuesday, we will find out what is the reading for British public sector net borrowing, Canada's core retail sales, and US existing home sales. On Wednesday, the situation will be a bit more interesting. We'll get flash manufacturing PMIs from the Euro area. We'll get British autumn forecast statement and US durable goods orders, as well as the FOMC meeting minutes. So Wednesday will be probably the most intense day of the week in terms of their economic data. On Thursday, the US will be on holiday, banks will be closed and not participating in foreign exchange operations. And Germany will release IFO Business Climate Index, which is also an important indicator for the euro. On Friday, there will be inflation data from Japan and the second estimate of British GDP for the third quarter. And this is what we have for this week. Not really much. If we speak about the US dollar, the highlight of the week is certainly the release of the FOMC meeting minutes on Wednesday. I can remind you that this meeting took place on November 2nd, and the Federal Reserve decided to leave policy unchanged, saying that it will watch incoming data and that there is still potential for US labor market to become even better. Still, we think that the main reason why the Federal Reserve didn't raise rates in November was concerns about the outcome of the US presidential race and US election. Now the Federal Reserve is saying that the market has accepted Donald Trump's victory rather fine. S&P 500 is doing rather well. US inflation expectations have increased, and actually we didn't see that kind of shock, that kind of demand for safe havens as it was expected to be. So the Federal Reserve will now have really little reason not to raise rates in December, and as much has happened already since November 2nd, when there was that meeting of the Federal Reserve. The minutes of this meeting shouldn't be a big game changer for the market. We already have comments from the Fed's chair Janet Yellen from last week, which represent a more fresh piece of data. So, in my opinion, you don't have to overestimate FOMC meeting minutes this time. They will probably do little to change the market's expectations for December. So probably US durable goods orders as the main piece of statistical data for the United States this week, maybe even more important for some kind of short-term intraday trading. As for some medium-term trading, I don't think that this piece of data will matter much either. And as for other pieces of data, we have some kind of different and interesting event in the United Kingdom. It is the release of British Autumn Statement. What is this event about? It means that British Chancellor of, or to put it more simply, Finance Minister, will deliver the information about about the British budget and the state of the nation's finance. It is an event which happens every year, and probably Philip Hammond, who is the British Finance Minister, will have to admit the largest deterioration in British public finance since 2011. Of course, this piece of news may affect British pound. It is an event risk for British pound. As the information about this event was published in Financial Times, the market didn't react much to the news that the report will be negative. So probably we won't have a great impact on the currency, but still it should be far from positive. Also, if we look at the data in Great Britain, which were released during the past week, we should say that Mark Carney, the governor of the Bank of England, in his testimony has said that he expects the inflation rate to rise despite the weak report on the latest annual consumer price index. And as a result, if we speak about British pound, we don't think that the Bank of England will resort to easing measures in the near-term future. This is a factor which supports the British pound. And we will speak more about the fundamental outlook for other currencies when we will have a look at the charts and discuss every pair in greater detail. Final thing from the presentation is this chart provided by Bloomberg and Danske Bank, which shows us how high correlated is the US dollar with the dynamics of US 10-year yields. We see here the correlation between US dollar Japanese yen currency pair, which is painted in blue here, and also the treasury yields, and the fact that these lines move close together, and this data suggests that the pair amount, the dollar yen should be trading is closer to 115 mark. And I suggest you to pay attention to this research, as It seems rather valuable and adequate to what is happening at the market right now. Let's now switch to the charts and discuss technical and fundamental picture for the main pairs. We usually start with euro dollar, and we will do this week as well. There were two very negative weeks for the single currency. The pair has actually weakened to the area of 106. The euro is losing to the US dollar as the Federal Reserve is expected to raise rates in December, while the ECB president Mario Draghi, on the contrary, hinted that the euro area stimulus will last. Annual inflation in the region accelerated from 0.4% in September to 0.5% in October, but still Mario Draghi underlined that the inflation remains far below the ECB's objective, and that the region's GDP growth was 0.3% in 3 months from July through September, at the same level as in the second quarter. So European economic growth isn't gaining pace. German economic growth slowed down a bit, and we know that Germany is the largest economy of the European Union. And another negative factor for the euro is the rising political risk, given many votes which are shadowed in Europe. I mean, Italian referendum, which will take place at the beginning of December, and next year's election in France and other European countries, which may lead to rise to power of some Euro-skeptic policymakers. And the market is currently pricing in this negative political risk, making the euro go down. This week, actually today on Monday, we will once again hear from Mario Draghi as he will testify about the European Central Bank's annual report before the European Parliament. This will happen at 18 p.m. MetaTrader time. Also, I've pointed out already that we will be watching PMIs for November on Wednesday and German business climate on Thursday. This is everything you need to know about the European economic calendar this week. Let's have a look at this weekly chart one more time. We can see that the euro has reached support line of 2016. Here we have this line drawn through 2015 lows, and this line is located, well, it is located just in the area of 106, 105.30. It depends on how precise your drawing of this line is. And of course, as euro has approached such multi-year minimums, these levels should provide some support for the single currency, and we already see some recovery in the euro on Monday. Still, we need to point out that the fundamental outlook suggests that traders will be selling the single currency on its attempt to recover. Let's have a look at the daily chart to find out what will be potential resistance levels for this currency. We can see stochastics here giving us a bullish signal, providing the room for a recovery. And 4-hour chart shows us that the next resistance is located at 106.85. This is the level which I have outlined last week. saying that decline below this level will lead us towards 105, and this level, which used to be a support, is now a resistance. A first resistance on the way up for the euro. The second one is located around 107.60, and the big one is in the area of 108.50. These are October minimums of the euro dollar. So I suggest you look at for the selling signals around these levels, around 106.85, 107.60, and 108.50 if we get this far. But we can see that on the 4-hour chart, the moving averages are making a negative order. This is 50-period moving average, when we have 100-period moving average and then 200-period moving average, and they are getting in the order, which signals the existence of the bearish trend. They are actually in this order for a while. The 50-period moving average failed to cross above 200-period moving average last week. The week before last, I'm sorry. And now it is going very rapidly, very steeply to the downside. So negative medium-term outlook for the euro and opportunities to sell the single currency at higher levels. At 1-hour chart, we can see that the moving averages are also in the negative order. They are the same periods here. They managed to get a bit higher, to get above 50-hour moving average, around 106.15, but it will face new resistance levels very soon. And at 1-hour chart, we know that the picture may change really soon. We saw that previously. The euro managed to get above this line, but failed to continue its way to the upside. So this is it. We can now speak a bit about the British pound. If we compare the dynamics of the euro and the British pound versus the US dollar, we can see that the British pound has actually made far better job of holding its ground than the euro. We didn't see this rapid decline after the US election. On the contrary, the currency managed to stabilize and even tried to recover to the area around 1.25. Still, the potential of the British pound to gain more is limited. And we can see that at the daily chart, the moving averages are also in this negative order. Previously, 50-day moving average has limited the pair's advance in the area of 1.2585, and the currency is getting one more time close to this level. If you look at the weekly chart, for some hints, maybe some trading signals, we also see a kind of top at 1.2585 here. So we need to get above this high for us to know that some kind of improvement is taking place, and that the bulls are trying to get hold of the market. All in all, stochastic is showing us something positive here, but with MACD close to negative levels, close to zero, we don't see strong momentum in this pair. We see a kind of continuation in more or less sideways dynamics for the British pound. If you look at the situation in British economy, we can see that there were some positive developments last week. British unemployment rate has declined. Retail sales have shown good gains, but there were some not as good figures. Average weekly earnings didn't show accelerated growth, and the number of jobless claims actually increased in Britain. So, despite the fact that British data are far better than expected after the UK decided to leave the European Union, still this data are not enough to make the British pound stronger than the US dollar. The general strength of the American currency is limiting the upside of the British pound. On the other hand, as there were some developments about Brexit, as there is speculation that Brexit might be delayed up to 2 years because of the decisions of British courts, the market is feeling a kind of relief. It is feeling that the Bank of England may not need to ease monetary policy further in the near term, and that all is becoming rather calm. Many analysts say that British pound is actually undervalued after its decline after Brexit news. And this kind of information is supporting the British currency. So what we are seeing is that two forces are acting here for GBPUSD currency pair. US dollar strength and the expectations of higher rates in the US are driving the pair lower, but a relief that Brexit will happen later than expected and probably will be delayed even for longer, or somehow Brexit will be rejected. This force is driving GBPUSD to the upside. And for now, we have a kind of balance of these two forces, and it's a bit difficult to foresee a real break of the current ranges in GBPUSD this week, as we have few data releases from both the Great Britain and the United States. As we are expecting a lower rate of the US dollar, some correction to the downside for the US dollar, as we have already spoken when we were watching the US dollar index chart. It means that we can assume that GBPUSD may try to test higher levels. All in all, if we look at the 4-hour chart, we can see that here the moving averages are horizontal, which shows us the lack of either bullish and bearish momentum. So here we have sideways dynamics, and one can clearly see that resistance for the pound is located at 1.25, 1.2550. And we have a kind of neckline near 1.23, 1.2315, and a decline below the lateral level will open the way down to 1.22 and 1.2150. If we fall below this support mark, we will have a kind of head and shoulders pattern here, which will allow the pair to test lower levels. However, if we get higher, then we will be able to get somewhere around this recent high, around 1.2673. And the upside potential for this week should be limited by resistance around 1.28, 1.2840. This is where the resistance line drawn through highs of the previous several weeks is drawn. So the main scenario from FX Bazooka is that British pound will try to test these higher levels, and these are our targets to watch. But decline below 1.2350, a fix below this level, 1.2340 maybe even, will open the way down to 1.22 and a bit lower. If we look at dollar yen, this is another pair which has made a very prominent move, and the previous resistance levels have turned into support marks. I suggest we start to look at the weekly chart, as it is probably the most informative for this pair right now. The weekly chart provides us support and resistance levels. These are Fibonacci levels from the decline of 2015-2016. We are now getting closer to retracement of 50% of this decline, and this Fibonacci level is located around 112.40. The pair managed to close last week above 110 mark. This is a very big move. Last week we were speaking about resistance provided by the weekly moving averages, which currently lie in the area of 108.50. These moving averages, which were breached to the upside, now have the role of support. So this is the main support level for this week, 108.50. And surely this previous resistance levels of 110 and 109.20 will also play the roles of support. All in all, we can see that after we breached from this uptrend, which was formed in October, we have actually, the size of this uptrend was about 500 points, and we have already reached the size of this movement projected to the upside. So we have already reached the main targets. Also, the moving averages on the weekly chart are about to show a negative intersection. The 50-day moving average is getting below 200-day moving average, and we see that stochastics indicator is in the overbought territory. MACD indicator shows us that there is still potential for increase in this pair, but as the rally was very intense, we can expect a kind of correction to the area of the moving averages line, to the area of 38.2% retracement at 109.20 before the US dollar will try to test higher levels and will try to get to 112.40 and probably even the next level, the next psychological level at least, which is located around 115. Let's put it at the chart. Here it is, 115. We have also here the 100-week moving average, and this may be the next target for dollar yen. But as many players must have fixed their profit around 110 mark, then we need to wait for some retracement in the pair. Let's switch to the daily chart. Here we also see that stochastic is in a very overbought area and MACD is also high. For now, dollar yen has been moving to the upside without any sizable corrections. Here we see that on the daily chart, the 50-day moving average is moving higher, and in some time it will cross the 200-day moving average to the upside, and this will strengthen this move of the pair to the upside. At the 4-hour chart, we can see that the moving averages are rising. They are in order showing the uptrend, but the recent highs of the price are not confirmed by highs of indicators of MACD indicator. So we should expect a correction. And here as well, we have levels around 108.50 to watch as our targets as support level. This is the main target for this week for dollar-yen. We now move to Australian dollar. And here we can see that the pair has shown significant decline after it breached support line of 2016. Here it is, this support line. It tested this line trying to get higher, but failed and continued its way to the downside. We went past through 200-day moving average during the last week. We actually closed below 0.74, and this move to the downside now requires some new targets. We can see that the pair got some support around 0.7330. And the next support is located at 0.7210. On the other hand, resistance is located at the previous support levels. They are 0.74 and 0.75 with 0.7440 on the way to the upside. What can they say about fundamentals of Australian dollar? Despite the positive meeting minutes of the Reserve Bank of Australia, the nation released mixed employment figures, and this local data didn't let Australian dollar to stand up to the US dollar strength, and as a result the pair declined. Commodity prices were also rather weak. The main commodities which are exported by Australia, such as iron ore and gold price, also declined, putting pressure on Australian currencies. If US figures this week are weaker than expected, then Australian dollar may show a more significant correction to the upside. We will watch these levels of 0.7440 and levels around 0.75, where we have 200-day moving average, our previous support mark. I think that levels around 0.75 will be rather good to re-enter short positions in Australian dollar if this 100-day moving average goes below 50-100 moving average, goes below 100-day moving average, providing a short signal here. If we look at the 4-hour chart, we can see that the setup still is negative here, so we will be having our finger on the bottom and looking for negative signal, for selling signal to enter short positions in Australian dollar. And at 1 hour chart, we can also have a look. Well, the setup is rather clear. All trend lines are in negative order. We have reached the first moving average, and the pair may correct a bit higher, but unlikely its recovery will be long and strong. New Zealand's dollar was hit by the earthquake in New Zealand and also by strength of the US currency. It also closed last week below 200-day moving average, and here today we are seeing a kind of attempt of the market to recover as it is in the oversold condition, but have a look at resistance of the previous 2016 trend line around 0.7130 and the next resistance around 0.72. We have a rather interesting situation in the US dollar, Canadian dollar. Fundamentally, US dollar is still strong. If we are analyzing US fundamental outlook, the prospects of the Federal Reserve's interest rate hike in December, but Canadian dollar has got support from higher oil prices, which managed to recover ahead of the meeting of the oil exporting countries, which will take place at the end of November. We actually see that there is significant resistance around 1.3575. This is 50% Fibonacci retracement of the pair's decline since the end of 2015 to May 2016. And for the second time on Friday, the pair failed to get above this level. So the bears will now test the uptrend line support, which is located around 1.34, and decline below this level will open the way down to test 1.33 before the US dollar will make another attempt to get higher. Overall, we have a kind of triangle here, a kind of consolidation, but the momentum is currently on the side of the bears, the short-term momentum. In the longer term, in the medium term, we still have a positive setup of the moving averages. On the daily chart, here we have 50-day moving average. Then we have 100-day moving average and 200-day moving average, a positive setup, which is speaking for the continuation of the uptrend. At the 4-hour chart, we can see that 50-period moving average around 1.3380 is now acting as resistance, and the pair is testing levels below 100-period moving average with the next target at 1.3334. So here we may have some trade opportunity which will materialize if we get below 1.3410, or for conservative traders below the recent minimum around 1.34. Pay attention to the economic data from Canada. Nation will release some important figures on Tuesday and later this week. So these figures, if they are good, they will be able to help Canadian dollar. All in all, Canadian dollar is less vulnerable to Donald Trump's policy, as Canada has managed to make a trade agreement with Europe. So this makes Canadian dollar less afraid of Donald Trump's trade protectionism. And all in all, Canadian dollar feels better than other commodity currencies. And some other pairs I'd like to have a look at. British pound is strengthening versus the single currency, and we expect it to test Euro GBP to test levels around 0.8440. As for US dollar Swiss franc, it's in reverse correlation with euro dollar, and this is why the pair has managed to break above the parity level, above 1 Swiss franc per US dollar, and is bound for higher levels. This level of parity is now acting as support. And gold is currently out of demand of the market because market players are rather positive about taking risk. Risk appetite is currently close to multi-year highs, according to Crédit Agricole Bank. And in these circumstances, gold is testing support level around 1,211. And the decline below this mark will open the way down to 1,170. So gold may lose these levels and get lower. We have here negative intersection of the moving average, the deadly cross of the moving averages, which has potential to bring the asset lower. Also, we have support at the weekly chart around 1,207, and I suggest watch this level on the downside as an important support for the asset. This is it for today, the dynamics of the main currency pairs. I thank you for your attention, and now we'll get a short summary of the ideas we've spoken about today. So, US dollar is enjoying strength after the US presidential election, but this week we don't have big important data releases in the United States. Also, there will be Thanksgiving holidays in America. And as a result, we expect traders to fix profit on their bullish US dollar bets. And we think that the US currency may be, after all, vulnerable for some correction versus other main currencies. The US Federal Reserve December rate hike is currently priced in almost fully in US dollars rate. Traders see more than 95% of the rate hike in the US in December, and as a result, this has already made the US dollar rise. There may be further bullish drivers for the US dollar, but after some correction. And if we are having targets for the currency pairs, we can say that euro dollar may correct higher to the levels around 106.85 and 107.60. The limit for correction to the upside is at 108.50, and we expect traders to sell the euro on its attempts to recover. For British pound, watch levels around 1.25, 1.2550. An advance above this level will open the way up to 1.2670 and 1.2840. Decline below 1.2350 will open the way down to 1.22. And for Britain, we have an important event, the autumn statement from the UK Ministry of Finance on Tuesday. Dollar yen may correct to 110, 109.20 and 108.50 marks before resuming its way to the upside towards 112.40. And Australian dollar is also trying to recover, but will meet resistance around 0.74.40 and 0.75. This is all for today. I wish you a profitable and great trading week, and we'll see each other next Monday to discuss what we have had during this past week. We will discuss our trade and devise new trade ideas for the new week. Thank you for your attention and goodbye. See you.